If you own real estate or your business owns the building it operates in, you may have opportunities for significant tax savings. With the passage of the 2025 One Big Beautiful Bill, cost segregation has become a significant tax strategy for real estate investors and business owners. So let's break this down. Cost segregation is a strategic tax planning technique that accelerates depreciation by identifying and reclassifying components of a building, such as electrical, plumbing, flooring, lighting, cabinetry, millwork, and certain HVAC systems from the standard 27.5-year or 39-year depreciation schedule into a much shorter schedule. Why does this matter? Because under the new 2025 tax law, 100% bonus depreciation is now permanent for qualifying property placed in service after January 19, 2025. That means eligible assets identified in a cost segregation study may be fully deducted in the first year with no phase down. The law also expanded what qualifies. Interior, non-structural improvements, classified as Qualified Improvement Property, or QIP, now clearly qualify for immediate expensing. Section 179 expensing limits were also increased to $2.5 million, with phase-outs beginning at $4 million, providing owners with more flexibility. The goal of this strategy is larger upfront deductions, potentially lower taxable income, and improved cash flow. Here's a hypothetical example. A business purchases a commercial building for $1 million. A cost segregation study identifies $350,000 that qualifies for cost segregation. Because 100% bonus depreciation is permanent, the owner can deduct the entire $350,000 in year one, potentially reducing taxable income and freeing up capital for reinvestment. This strategy may be effective for commercial and multifamily property owners, business owners who own their facilities, short-term rental properties structured properly, developers, manufacturers, and research and development intensive businesses. Beyond tax savings, cost segregation seeks to improve after-tax cash flow, strengthen return on investment, and enhances property valuation and financing metrics. Timing is a key factor. The law is fully in effect now, and timing matters. One important clarification: even if your property was placed in service years ago, you may still benefit from cost segregation today. The IRS allows owners to perform a cost seg study retroactively and take certain missed depreciation in the current year through a permitted accounting method change without amending prior returns. While the new law's permanent 100% bonus depreciation applies only to qualifying property placed in service after January 19, 2025, retroactive cost segregation can still unlock significant immediate deductions based on the depreciation rules in effect when the property was originally placed in service. Cost segregation is significant tax savings available under the 2025 tax law, and its effectiveness depends on proper valuation and implementation. Schedule a no-obligation 15-minute strategy session to determine whether cost segregation applies to your properties. See how cost seg may help you make your real estate work harder.